In exactly 48 hours, something is going to happen to the silver market that could change everything. I'm not talking about a gradual shift or a long-term trend. I'm talking about a sudden explosive event that smart money has been positioning for over the past 6 months. And if you're not prepared, you're going to watch one of the greatest wealth transfer opportunities of the decade slip right through your fingers. The clock is ticking, and what I'm about to show you is so time sensitive that every hour you wait could cost you thousands of dollars in missed gains. Stay with me, because this is not a drill. Welcome to George Vance Live, where we give you the financial intelligence that Wall Street doesn't want you to have. If this is your first time here, you need to subscribe right now and smash that notification bell, because in 48 hours, this information could be worth more than you can imagine, but only if you act before the window closes. Let me start by telling you exactly what's happening in 48 hours, because the specifics matter. March 15th marks the settlement date for one of the largest silver futures contract expirations in the past 5 years. Over 150 million ounces of silver are set for delivery, and here's the problem. The physical silver to fulfill those contracts doesn't exist in the quantities needed. The COMEX warehouses that are supposed to hold the silver to back these contracts are showing inventory levels that are dangerously low. We're talking about a potential default scenario where buyers demand physical delivery and the exchange simply cannot provide it. Now, you might be thinking they'll just roll the contracts forward or settle in cash like they always do. And normally you'd be right. But this time is different. This time, there's a perfect storm of factors converging that is going to force physical delivery on a scale the system can't handle. Large institutional buyers, including several sovereign wealth funds and at least 2 major industrial users, have publicly stated they will demand physical metal, not cash settlement. They're calling the bluff, and the COMEX is about to be exposed. Here's why this matters so much. Silver has been manipulated for decades through paper contracts that represent far more metal than actually exists. It's the worst kept secret in commodity markets. Banks and traders create endless paper silver through futures and derivatives, suppressing the price and allowing them to profit from the shorts. But when someone actually demands the physical metal and the vaults are empty, the entire scheme collapses. Prices have to spike to find real metal, and anyone holding physical silver or positioned correctly makes extraordinary gains. The setup we're seeing right now is reminiscent of what happened with nickel in March 2022, when the London Metal Exchange had to halt trading because a short squeeze sent prices up 250% in 2 days. Traders who were short couldn't deliver the physical metal, and the entire exchange faced systemic failure. They literally had to cancel trades and shut down the market to prevent a complete meltdown. The same dynamics are building in silver right now, but on an even larger scale because silver's industrial demand is exploding while supply is constrained. Let me walk you through the factors that are creating this crisis. First, industrial demand for silver is at all-time highs and accelerating. Solar panels use massive amounts of silver. Each panel requires about 20 grams, and global solar installation is growing exponentially. Electric vehicles use significantly more silver than traditional cars because of all the electronics and electrical systems. 5G infrastructure requires silver. Medical devices use silver for its antimicrobial properties. The industrial consumption of silver has increased by over 30% in the past 3 years, and that demand is not discretionary. These industries need physical metal, and they need it now. Second, mine supply is actually declining. Despite higher prices, new silver mines aren't coming online fast enough to meet demand. Most silver is produced as a byproduct of other mining operations, primarily copper, lead, and zinc. When those base metal prices are low, or when environmental regulations make new mining difficult, silver supply suffers. We are currently facing a structural deficit where annual consumption exceeds annual mine production by over 200 million ounces. That deficit has to be made up from above-ground stocks, and those stocks are being depleted. Third, investment demand is surging. Retail buyers around the world are waking up to silver's value as an inflation hedge and a monetary metal. Coin and bar sales have been breaking records. The U.S. Mint has struggled to keep up with Silver Eagle demand. Premiums on physical silver have been elevated for months, sometimes 30 to 50% above spot price. That tells you there's a disconnect between the paper price and the physical reality. People want the real metal, and they're willing to pay up to get it. Fourth, and this is critical, there's been massive accumulation by smart money. If you track the flows, you can see that certain large players have been quietly building enormous positions in both physical silver and silver mining stocks. These aren't speculators looking for a quick trade. These are sophisticated investors who've done deep analysis and concluded that silver is dramatically undervalued relative to its industrial importance and monetary properties. When the big money moves early and quietly, you should pay attention. Now, let's talk about what happens in 48 hours when this powder keg potentially explodes. If even a fraction of those 150 million ounces in expiring contracts demand physical delivery and the COMEX can't provide it, several things happen very quickly. First, the exchange might try to settle in cash at elevated prices to avoid default. That immediately sends the spot price higher as traders realize the shortage is real. Second, anyone holding short positions faces devastating losses and has to cover by buying, which drives prices even higher. Third, the broader market sees what's happening and piles in, creating a momentum-driven surge. Fourth, and this is where it gets really explosive, other contract holders realize that demanding physical delivery is profitable because there's a massive premium between paper and physical. This creates a cascade where more and more contracts demand delivery, overwhelming the system. The exchange faces a choice: default on contracts and destroy their credibility, or let prices run to whatever level is needed to attract physical metal from holders. Either scenario is catastrophic for shorts and phenomenal for longs. The historical precedent for this kind of event is the Hunt Brothers silver squeeze in 1980, when silver went from $6 to $50 in a matter of months, as the Hunts tried to corner the market. Now, I'm not saying we're going to see $50 silver in the next few days, but I am saying that a move from current levels around $25 to $35 or $40 within a couple of weeks is entirely possible if this delivery crisis plays out. That's a 40 to 60% gain in a very short time. And if you're positioned in leveraged instruments like silver mining stocks or options, the gains could be multiples of that. Let me show you the evidence that smart money is already positioning for this. Look at the options market. There's been unusual activity in call options on silver ETFs like SLV and on major silver miners like First Majestic, Pan American Silver, and Wheaton Precious Metals. Large buyers have been purchasing out of the money calls expiring in March and April, betting on significant price appreciation. This isn't retail speculation. These are sophisticated trades in large size that indicate institutional knowledge of something coming. Look at the short interest in silver mining stocks. It's been declining, which means shorts are covering. When shorts cover before an event, it tells you they know something or they're reducing risk because they see danger ahead. At the same time, insider buying at several silver miners has increased. Company executives buying their own stock with their own money is one of the strongest bullish signals because they have access to information about their business that the public does not. Look at the physical market premiums. When you go to buy actual silver coins or bars right now, you're paying $3 to $5 over spot price, and in some cases more. Delivery delays are stretching to 4 to 6 weeks for certain products. Dealers are struggling to source inventory. This is the physical market telling you that demand far exceeds supply at current prices. The paper price hasn't caught up yet, but it will have to when the delivery demands hit. Look at the warehouse stocks at COMEX. Registered silver, which is the category available for delivery against futures contracts, has been steadily declining. We're at multi-year lows in terms of registered inventory relative to open interest. The ratio is completely out of whack. In a healthy market, you'd want at least a 3-to-1 ratio of inventory to open interest. We're approaching 1-to-1 in some contract months. That's a red flag screaming that a squeeze is possible. Now let me tell you how to position yourself in the next 48 hours to maximize your gains from this event. Time is critical, so you need to act decisively. First option, physical silver. If you can get your hands on physical metal before this breaks, do it. Coins, bars, whatever you can find at reasonable premiums. The advantage of physical is there's no counterparty risk. You own the metal outright. The disadvantage is lower leverage, and you'll pay premiums. But if the thesis plays out and physical premiums explode even higher, you'll still profit handsomely. Second option, silver ETFs like SLV or PSLV. These give you exposure to silver price movements without the hassle of storing physical metal. PSLV is generally considered better because it's fully allocated and you can actually redeem for physical if you have enough shares. SLV has been criticized for potentially not having all the silver it claims, but it's more liquid for trading. If you're looking for quick exposure and the ability to trade in and out, ETFs are efficient. Third option, and this is where the real leverage comes in, silver mining stocks. When silver prices move up, mining stocks tend to move up by multiples because of operational leverage. A company producing silver at 15 per ounce costs selling into a 25 market, makes 10 profit per ounce. If silver goes to $35, they're now making $20 per ounce, doubling their profit margin. That flows through to stock prices. Look at companies like First Majestic Silver, Hecla Mining, Kerr Mining, Pan American Silver. These are established producers with operating mines. You can also look at royalty companies like Wheaton Precious Metals or Franco-Nevada, which have lower risk profiles because they don't operate mines. They just take a percentage of production from mines they've financed. Junior miners and exploration companies offer even more leverage, but with much higher risk. Companies like Silver, Rest Metals, or Endeavor Silver could see explosive moves if silver runs, but they could also go nowhere if the thesis doesn't play out. Fourth option for the most aggressive traders, options on silver or silver miners. Call options give you massive leverage because you're controlling a large position with a small amount of capital. If silver moves the way I'm suggesting it could, options could turn a small investment into life-changing money. But understand the risks. Options can expire worthless if the move doesn't happen in the expected time frame. This is not for beginners or anyone who can't afford to lose their entire investment. But for sophisticated traders who understand options, the risk-reward is compelling. Let me give you a specific example of how this could play out. Say you buy call options on SLV with a $28 strike price expiring in April, and you pay $0.50 per contract. Silver is currently around $25, so you need it to move above $28.50 just to break even. But if the squeeze happens and silver rockets to $35, those options are now worth at least $7, a 14x return on your money. That's the power of leverage, but again, only for those who truly understand what they're doing. Now, let me address the risks, because I'm not here to sell you hopium. I'm here to give you realistic analysis. What could go wrong with this thesis? First, the COMEX could change the rules. They've done it before. They could increase margin requirements to force liquidation of long positions. They could allow cash settlement at current prices instead of forcing physical delivery. They could halt trading if things get too volatile. The exchange has enormous power to manipulate outcomes when they face systemic risk. Second, the large buyers demanding delivery could be convinced to accept cash settlement or roll their contracts forward. If you're a big institution and the exchange offers you a premium over spot to settle in cash rather than cause a crisis, you might take it even if you originally wanted physical. Backroom deals happen all the time in commodity markets. The little guy never sees them, but they can completely change the outcome. Third, there could be a coordinated intervention by central banks or governments. If silver squeezes hard enough to threaten the broader financial system or to expose the manipulation that's been happening, powerful players have an interest in suppressing it. They could flood the market with supply from strategic reserves. They could impose trading restrictions. They could coordinate with exchanges to prevent delivery. Never underestimate the system's ability to protect itself. Fourth, the timing could be off. Maybe the squeeze happens, but not in 48 hours. Maybe it takes another month or two for the dynamics to fully play out. If you're positioned in options that expire before the move happens, you lose even if you were right about the direction. Timing is everything in options trading, and it's the hardest thing to get right. Fifth, there could be a broader market crash that takes everything down, including silver. If we see a major sell-off in stocks and a liquidity crisis, even assets that should hold value, like precious metals, can get sold as people raise cash to meet margin calls elsewhere. It happened in March 2020 when gold and silver both dropped initially despite being safe havens, because everyone was selling everything to get dollars. Given these risks, here's my recommendation for how to position. Don't go all in on one approach. Diversify your silver exposure. Put some money in physical that you can hold long-term regardless of short-term price moves. Put some in mining stocks that give you leverage but can be held if the timing is off. Only put a small speculative amount in options. And only if you understand them and can afford to lose it. This way, you're positioned to benefit if the squeeze happens, but you're not destroyed if it doesn't play out exactly as expected. The key insight here is that whether the squeeze happens in 48 hours or takes a few months, the fundamental setup is bullish for silver. The industrial demand is real and growing. The supply deficit is real and widening. The paper manipulation can't continue forever when physical demand is this strong. At some point, reality reasserts itself. The March 15th contract expiration is just a potential catalyst that could accelerate the timeline. Even if it doesn't trigger immediately, it's highlighting the structural problems in the silver market. Think about the bigger picture for a moment. Why is silver so important right now beyond just this immediate trading opportunity? Silver is the most electrically and thermally conductive metal. It's essential for the technological economy. Every major trend in technology, from renewable energy to electric vehicles to 5G to medical devices, requires more silver. At the same time, silver has been money for 5,000 years. It's a store of value and a hedge against currency debasement and inflation. So you have this unique metal that's both an industrial commodity and a monetary asset. The gold to silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, is currently around 90 to 1. Historically, that ratio has averaged closer to 50 to 1, and in nature, silver occurs about 17 times more abundantly than gold. When the ratio gets extremely high like it is now, it suggests silver is undervalued relative to gold. If the ratio reverts to historical norms while gold stays at current levels around $2,100, that implies silver should be at $40 to $50. That's a doubling from current prices. Central banks around the world are buying gold at record rates because they're diversifying away from dollars and preparing for currency instability. But silver does not get the same institutional buying because it's harder to store large quantities and the market is smaller. However, That smaller market size means it takes less capital to move the price dramatically. If even a fraction of the money flowing into gold shifted to silver, the price impact would be enormous. Silver is the coiled spring waiting for a trigger. Here's what I want you to understand about the next 48 hours. This is not about gambling or speculation. This is about recognizing a fundamental supply-demand imbalance that has to resolve itself. The paper markets have suppressed silver prices below where the physical reality would suggest they should be. Every day that continues, the imbalance gets worse because industrial users are consuming physical metal while the futures market creates infinite paper metal. At some point, the physical market overpowers the paper market. We might be at that inflection point right now. Whether you choose to act on this information or not, I want you to watch what happens over the next few days and weeks. Watch the silver price. Watch the delivery data from COMEX. Watch the premiums on physical silver. Watch the mining stocks. This is a masterclass in how commodity markets actually work versus how they're supposed to work. You're going to see the tension between paper and physical play out in real time. It's educational even if you don't have any money at risk. If you do choose to position yourself, do it strategically and with risk management. Don't bet money you can't afford to lose. Don't use leverage you don't understand. Don't go all in on one position. Scale into positions. Maybe buy some today, some tomorrow if prices dip, some after the contract expiration to see how it plays out. Dollar cost averaging works for trading setups just like it does for long-term investing. It reduces your risk of buying at the absolute wrong time. Set profit targets ahead of time. If you buy silver or silver stocks and they run up 30 or 40% quickly, take some profits. And don't get greedy and hold for the last dollar. Markets can reverse just as fast as they advance. Similarly, set stop losses to protect yourself if the thesis is wrong. If you buy a mining stock at $10 and it drops to $8.50, maybe that's your signal to exit and preserve capital. Having a plan before you enter the trade is what separates successful traders from gamblers. I also want you to think about this as potentially the first move in a larger precious metals bull market. If silver squeezes and makes a dramatic move, it will draw attention to the entire sector. Money will flow into gold, platinum, palladium, and mining stocks across the board. People who've forgotten about precious metals will suddenly remember why they matter. This could be the catalyst that starts a multi-year run in the sector. So even if you miss the immediate move, understanding the dynamics positions you for future opportunities. The establishment does not want you to know about this. They don't want retail investors figuring out that the commodity markets are manipulated through paper contracts. They don't want you understanding that physical delivery can break their system. They don't want you positioned to profit when their schemes unravel. That's why this information is so valuable and why you need to share it. Send this video to everyone you know who cares about protecting and growing their wealth. Post it everywhere. The more people who understand what's happening, the more pressure on the manipulators. Subscribe to George Vance Live right now if you haven't already. Turn on all notifications because the next few days are going to be critical, and I'll be providing updates as the situation develops. This is the kind of time-sensitive intelligence that can make or break your year financially. You don't want to miss it because you weren't paying attention. Drop a comment below telling me if you're positioned for this move and what your strategy is. Let's build a community of informed investors who help each other navigate these opportunities. The clock is ticking. 48 hours until March 15th and the contract expiration that could change everything. The smart money has been accumulating for months. The physical market is screaming shortage. The industrial demand is insatiable. The paper manipulation is unsustainable. All the pieces are in place for an explosive move. The only question is whether you're going to be positioned to profit from it or whether you're going to watch from the sidelines and wish you'd acted. I've given you the analysis. I've shown you the evidence. I've explained the opportunity and the risks. Now it's up to you. This is your moment to make a decision that could significantly impact your financial future. Don't let fear or indecision paralyze you. Don't let this opportunity slip away because you waited for perfect information or perfect timing. In trading and investing, perfection doesn't exist. You make the best decision you can with the information available, and you manage the risks. This is George Vance Live, giving you the truth about markets that Wall Street doesn't want you to understand. The silver market is about to show you what happens when reality collides with manipulation. Make sure you're on the right side of that collision. Stay informed, stay positioned, and whatever you do, don't say you weren't warned when silver explodes and you missed it. The next 48 hours could define your financial year. Act accordingly. Until next time, stack silver, protect your wealth, and never trust the paper markets when the physical market is telling you a different story.